Hello guys, welcome to lesson 5 of the course, and today we're going to talk about equilibrium, discount, and premium. Now before I go into the concept of equilibrium versus discount and premium, it is first to conceptually define the terminologies of all of these. Now what I'm going to do here is, before I go into price action itself, I will first off discuss buying and selling. So here we're going to use a real world example, something you can easily relate to communicate the idea of premium versus discount. Now let's say you wanted to do a business. What's going to be the first goal of running the business? Obviously it's to make profit. Now I understand you want to deliver products to the customer, something usable or something that changes society in a positive way. Those are all good things, but at the end of the day you want to be profitable, because if your business is not profitable, then you cannot run your business for longer. So if we relate this to trading, I'm not talking about trading the foreign exchange market. Now I'm talking about real world trading. If you were a seller, let's say you had a store, for example, and you were selling products at that store, you want to make sure you're making money off the products you're selling. Okay, so you want to make sure that the products you're selling, you're producing them at a cheaper price than you are selling them. Because if you're selling them at a more expensive price than you're producing them, now you're operating at a loss and your business can never be profitable, and that means that your business is going to close up shop real quick. And that basic premise of buying and selling is essentially what you're doing in price when you're trading the foreign exchange market. Okay, now the question is, think about Black Friday, for example. Why do you think there's so many people who rush to get product during Black Friday? Because prices are cheaper for them. Alright, now let's say you were a reseller and you resold sneakers. And I've seen sneaker conventions where they'll resell a $250 sneaker for like $1,000 or $1,500, something like that. One of my sneakers actually got that from one of those type of conventions online, and the retail amount was, I think it was around $230 or so, and I actually got it for about $800 plus. And that's one of my best sneakers I use. And the reason why is because these people, they'll purchase the sneaker knowing that that's a limited edition sneaker, and what happens is there is a short supply of that sneaker and the sneaker is in demand, and so they can inflate prices because they know people want the sneaker because it is a limited edition, and they can sell for a higher price. So essentially what that sneaker reseller is doing is that person is buying at a discount to sell at a premium. In other words, the person is buying it while it is cheap and selling it while it is expensive. Okay, so this is the basic act of trading. Your goal to be a profitable trader is to buy while it is cheap and sell while it's expensive. That's how every business is run. If you're offering a service, you want to make sure you're being profitable at the service you're offering. Okay, so that means when you're getting paid, you want to make sure that you're getting paid at a premium, right? That's you're making profits. So that's also the same thing with trading. The goal, if you're wanting to be a buyer in trading, is you want to buy when it is cheap and you want to sell that same asset when it's expensive because it has increased in value. Same thing if you want to be a seller in price, you have to sell while it is expensive so you can buy back while it is cheap. Now let us define the concept of buying and selling in trading. So we're going to use a blank chart, and here I have a chart of GBP Aussie, which we're going to just focus on for today's lesson. And what I'm going to do is I'm going to scroll out and we're going to use just a blank screen. Okay, so what I'm going to do here is I'm going to do an hypothetical long here in this scenario. So we have an hypothetical long in the marketplace. Now when you go into the marketplace and identify setup and you take a trade to buy, what you've done is you've bought that asset at market order. Okay, So this is British pound Aussie. That's the pair right now we're on. So by placing a buy, you're buying British pound against Aussie. That's what you're doing. Now your stop loss is a level in price where you want to sell your buy positions at a discount. Okay? Because you think the market is not going in your intended direction. Meaning you bought here. If the market stops you out, what essentially you're doing is you're buying back, or sorry, you're selling your position, your bought position, you're selling that bought position at a loss. So a stop loss in a buy order is a market execution to sell. Otherwise, or in other words, your stop loss in a buy order is a sell limit. Okay, so when the market goes against you, what it is doing essentially is the market is declining, and once it gets your stop loss, that sell limit becomes a market order to sell. Same way if you also have a take profit. Okay, so your stop loss is a market order to sell once the market triggers the stop loss, and your take profit is a market order to sell also, but this time you're selling at premium. Now let me ask you a question. Let's assume you wanted to buy a sneaker, okay, a limited edition sneaker, and let's see if we can find an emoji for sneakers. Sure, one. I'm not sure we can find one on this. Let's see, we have symbols, flags, we have objects, we have arrows. Let's go look at emojis. Let's look for sneaker emoji. So I'm trying to communicate this concept as plainly as possible so you understand what I'm trying to indicate on this. Let's see. Can we get sneakers in sports? Is it gonna be in sports? This is a rollerblade sneaker. Can we get shoes? Basic shoes, that's fine also. So let's go back to this and see if we can find shoes. So let's see if we can find shoes. Again, I did not. I don't script the lessons, so that way I can free flow when I'm teaching. So everything you're getting in this, you're getting it raw and it's all smooth, and that way we can communicate the information we want to communicate effectively. Alright, so I'm gonna see one more time if I can find sneakers in this. If I cannot, then I'm probably gonna use that rollerblading emoji I found. This is travel places. We're gonna use that emoji there. Let's see if we can find more. Should probably one instead of this. Oh yes, finally. Knew it. Alright, so let's assume this is the Jordan 1s. So there was a limited edition collab between Nike and, let's say, Travis. Okay, so this is Travis 1s, and it's limited edition, and the retail in price from Nike on this, let's call it $200. Oh, come on. Okay, so the retail and price for this Jordan 1 times Travis collab is collab collection. That is $200. That's a retail price. So you go when it's out, you rush to buy the sneaker. $200, you paid for it. Now you're happy. All right, you bought the sneaker at $200. Now let's say you wanted to sell this sneaker, and you found a buyer, and the buyer's offering $150 for a sneaker. Okay, so now you have a buyer. All right, so we're gonna call this person buyer 1, and buyer 1's offer is $150. That is the offer from buyer one. If you sold your sneaker to buyer one $150 that you bought from Nike at $200, are you making profit or you're making a loss? You're making a loss. Okay? Why? Because you're selling the sneaker at a lesser value than you bought it. So you're losing $50 on this transaction. So if you sell your sneaker to buyer one, you're losing $50 on transaction. Okay? Boom. So if you sold this to buyer one, now you're losing $50. Now let's say you found another buyer. We're gonna call that person buyer two. Okay. Now buyer two understands the value of the sneaker and says, bro, I know just so many people that want to get a sneaker, so I'm willing to pay $800 for this sneaker. Are you making money or are you losing money in this transaction? You're making money, alright? How much are you making in this transaction? You're making plus $600 on the transaction. So if you sell to buyer one, you're losing $50. If you sell to buyer two, you're making $600. That is the same thing with trade. So buyer one is going to be your stop loss, right? You bought this at $200. So if you're selling at a lesser amount than you bought that sneaker, you're losing money. So that's going to be a market order to sell, and you're losing $50. But if you sell at a higher price than you bought the sneaker, that is a market order to sell, but at a premium. So what you're doing here is you're selling your shoe which you purchased at a discounted price versus the amount you got it for. Versus number two, where you're selling your sneaker at a premium amount than you got it for. You see? So now what we're gonna do here is we're gonna define premium versus discount. So now it's starting to make sense. What is premium? Premium is the measurement, of the expensiveness of an asset. That is premium in trading. That is the definition of premium. And what is discount? Discount is the measurement of cheapness of an asset. So we've defined premium as the measurement of expensiveness of an asset. We've defined discount as the measurement of cheapness of an asset. Now let's define equilibrium. Okay? Equilibrium in this example, using this sneaker example, would be selling your sneaker which you've never worn to a buyer who wants to buy it at the same price as you bought from Nike. So that's going to be buyer 3. Now buyer 3 wants to buy your sneaker at the same amount you got it for, which is $200. And now you have buyer 3. Okay, so buyer 1, this is discount. Buyer 2, this is premium. Buyer 3, this is equilibrium. So price isn't changed. So now how do we relate this example I just described to price? Now the asset you got, which is the sneaker, for that price, at that $200 price you got the asset for, okay, that's what we'll call a trading range. So what is a trading range? A trading range is an oscillation. Okay, so let me type out the words so you understand what I'm saying. A trading range is an oscillation. By the way, right now I'm winging it and I'm using my knowledge of price to define this. A trading range is an oscillation of price that defines the measurement of premium versus discount in an asset at a particular time. Oh, this is the first time you're hearing a definition like that. Alright, so that is the definition of what a trading range is. A trading range is defined as an oscillation of price. Again, remember the very important element in this, which is the time. Because you can have a 1 minute trading range, you can have a daily trading range, you can have a 5 minute trading range, you can have a 4 hour trading range. It all depends on the time frame you're looking at that trading range. So a trading range can be defined as a measurement of premium versus discount in a range of price at a specific time. So now in this example, our trading range is going to be from this low all the way up to this top. There. Alright, so now we have a defined trading range from this run lower to the run higher. So this is a range defined by the daily time frame. Now that we have this range, what we're going to do is we're going to define premium versus discount. And then equilibrium. So the first thing we do is we'll define equilibrium. Equilibrium always is going to be halfway through the range. So the middle of that defined range is what we define as equilibrium. Now that we define equilibrium, anything above equilibrium, that's premium. Anything below equilibrium, that's discount. Now let us explain why this is important in trading. If the institutions are going to accumulate, they will do so at discount. If they're going to distribute, they will do so at premium. Sounds easy, right? Let me go even more. In this run up to this range here, where we're at buy to liquidity, we have this entire run lower. Now let's define this range. High, all the way down to the low, and we have our 50%. Meaning, here, institutions should be accumulating. Here, they should be distributing. Does it make sense now? Why? Because they have to buy while it is a discount or while it is cheap, to sell while it is a premium or while it is expensive. Okay, so they have to sell price at a higher price than they bought it, because that's how they make profits. If they sell at a lower price than they bought it, now you're in a loss or you're losing. So they have to sell at a higher price than they bought it. The only way they can sell is if the market trades up into premium. And this is where we get into counterparty liquidity. So now I've got some of you guys asking the question, what is counterparty liquidity? If you're buying, going back to that initial example I used of the sneaker, okay, buyer 1 is going to be counterparty liquidity. Buyer 2 is counterparty liquidity. Buyer 3 is also counterparty liquidity. So when you place a trade to market execute buy in a position, what you're doing essentially is you need to have someone take on the opposing side of your trade. Okay? Because if you wanted to buy your sneaker, going back in the first example, if there's no one to sell the sneaker to you, how can you get your sneaker? Same way, if you bought your sneaker and now you're holding the sneaker that you bought, if there's no one to buy that sneaker back from you, how are you going to get rid of the sneaker? How are you going to sell the sneaker? Alright, so if you want to sell something, there needs to be someone willing to buy that thing from you. That person willing to buy that thing from you, that's what we call counterparty liquidity in price. Okay, so if the institutions are accumulating price, they have to sell to someone else. Usually that someone else is going to be the central banks. Okay, so that someone else you're selling to is who we call counterparty liquidity. So you're taking on the opposing side of our order. So meaning if I went to Starbucks, for example, and I wanted to get coffee, okay, the person I'm buying coffee from is my counterparty liquidity in trading terms or institutional terms. Okay, for a transaction to occur, there needs to be counterparty liquidity. Alright, there needs to be an exchange of asset. So if you went to Starbucks and you're getting coffee, you're exchanging your money for coffee, which is a commodity. So there needs to be an exchange of asset, or there needs to be an exchange of commodity. So if you went to Starbucks and you went to get coffee, you're essentially exchanging your currency notes, which has value, for coffee which has value to you. So the same way in trading, when institutions are long, right, they need counterparty liquidity to offset that long position against. Otherwise, they cannot exit that trade, or they cannot exit that execution you're on. So when we talk about counterparty liquidity in layman terms, which I just explained, is essentially someone who is there to take on the opposing side of your trade, so that you can get out of a position either profitably or at a loss. Now, a lot of times when you execute on your broker usually will take on your risk, because 9% of people who trade through brokers, they operate at a net loss. All right, so the broker is very certain that by taking on your trading risk, they can book themselves money, because now they're being counterparty to your trade, and when you're losing money, you're getting your money from me. That's what happens sometimes, not all the times. Sometimes, other times they will just feed your order directly to the interbank price feed, which will find a counterparty liquidity for you to pay your order against. Okay, so that's usually how brokers work. Now you understand equilibrium, you understand premium, you understand discount. Now we're going to go into advanced premium versus discount. So if our assumption is below the 50% of this range high down to the low, institutions are accumulating there, you can see we have a volume imbalance. By the way, if you're wondering about inefficiencies, we'll talk about that more. I think that's going to be on the next lesson. Yeah, so the next lesson is going to be the more juicy lesson, because that's one of my favorite lessons, fair valuation. Okay, so you can see at this volume balance, we're accumulating price, which is discount. This is a discount array, so this is what we'll call a bullish volume balance, and you can see the explosion to the upside. And where's the market reaching for? The market is reaching for premium, where there can be counterparty liquidity because the institutions were accumulating a discount. Okay, now we're going to talk about advanced premium versus discount. I know I'm going to get questions about this. This is going to be the part of the video where you study probably multiple times to fully grasp what I'm indicating. So if the assumption is that institutions are accumulated down here, and you're aiming for the buy side liquidity up here to exit against counterparty liquidity, we can use that to our advantage. Okay, if distribution is to come into the marketplace, then that will be indicated by bearish candles or down candles in price, indicating distribution. So distribution, aka selling. All right. Now, if I went to lower time frame from JP Aussie from yesterday, you would see after we run above that daily high. Again, whenever we're discussing daily liquidity, we don't want to see a shallow run, something like this. We want to see a deep run into daily liquidity, because the liquidity resting around those levels, you're not retail liquidity, you're usually fund level liquidity. Okay, and fund level liquidity, they have deeper pockets than classic retail, so that's why the market usually will run deeper into daily levels. Usually I like to see 30 pip swings, runs or more, sometimes around daily levels. Here we have a 69 pip run, but that's because this is Aussie. It's not, and it's very volatile. So now after we run up into that liquidity, the anticipation is I want to see distribution coming to the marketplace, indicated by a run lower. Now we have the market run lower, distribution, and in the process the market breaks a short-term low. Alright, so we have a break in structure, or what I call a shift in structure. Now if we have a shift in structure, okay, what is the market shifting from? The market is shifting from a bullish state of delivery to a bearish state of delivery, indicated by the run below this low here. Now why should the market not probably run higher? Because that run lower was coming off the heels of distribution at premium. Okay, so now that the market is working lower, the market has to return into a deeper discount. So what discount are we talking about? Well, we have a range. This is the low of the range that starts all the run higher prior to the shift in market structure. So what we'll do here is we'll define the low of that range to the high of the range. Now if the institutions are going to accumulate longs, they have to do so at discount, just like we discussed. So meaning that they have to get below this, which is the equilibrium of the range, where we have discount. Anything above, that's premium. Anything below, that's discount. So they have to get down to discount if they are to continue higher. Now, anything above this line, that's a premium. Meaning, again, we want to sell a premium. We don't want to buy a premium. Why? Because we're going to be buying it while it is expensive if we're buying a premium. So we want to buy it while it is cheap, meaning we have to wait for price to get down to discount. But we don't need to wait for price to get down to discount if it is trading at a premium. Now you're going to look at this and say, well, I use my Fibonacci from the high to the low, and it never really got up into a level where I want to short, because it just got up into equilibrium and sold off. And this is where we get into advanced premium versus discount. Now, prior to the run and shift the market structure, what was the market doing prior? The market was running higher. So what was the delivery state? Delivery state was bullish. Now, where do we shift into a bearish delivery state? As soon as we run below these last up candles, which will be a bearish order block, we shift the delivery state. Where? At the lowest open of these two up candles, because those up candles makes up a bullish order block. Again, we're not using the wicks, because the volume of transactions is going to be in the bodies of the candle, not the wicks. Okay, remember the definition of order blocks. Institutions will sell into a rally. They'll sell into up candles, and then the algo will drive the market lower, which is what we've seen here. Market drives price lower after market makes higher high from these top candles. So the assumption here is above this daily high, we're seeing shorts coming to the marketplace, indicated by the run lower and shift the market structure. So we shift delivery state from the opening price of this candle here. That's what we shift delivery state to a state of bearishness. So what follows is you pull your Fibonacci from the open of the candle where we shift delivery state all the way down to the low, and you get your premium. What is your premium rate? The market is trading back up into a balanced price range. So we have a fair value gap, and if you look to the left, you can see the market runs on one pass. Again, if you're confused about what balanced price ranges are, that's going to be the next lesson. I've done a session on balanced price ranges, and I'm going to make that available to you guys. Alright, so the market shifts up into a balanced price range, follows the rules, does not trade through 50% of the range. So let me define the range for you guys so you're not confused. Okay, so this is the fair value gap, but it's not just fair value gap, it's also BPR, because on to the left we have the market trade on one pass. So if you took your Fibonacci from the low of that fair value gap or BPR to the high, you see the market never closes above 50% of that inefficiency. Shares of bear, sells off. Now this is a break in structure. This initial run lower, that's a shift in market structure. This run here, that is a break in structure. Now if we went lower to a lower time frame, and again, this is today's price action. The first thing we need to define is there a draw on liquidity at discount? Is there a very clear PDA rate at discount that the market could reach for? Yes, there is, and the answer is this fair value gap, and then we have a smaller consolidation, which would be draw on liquidity. Now if we went to lower time frame, you can see we have a break in structure. The market runs below short-term low and then retraces again back into the upside. Now watch this. Where do we shift delivery? Because we're bullish initially up into that fair value gap, and now we're bearish. We shift delivery at this last up candle. Again, we're gonna use, now this has no wicks, so we're gonna use the open. But even if without wicks, you always use the open for a bearish order block, because we're using the bodies of the candle and not the wicks of the candle. Okay, now you have the market trade up into premium. Not only is this a premium, but this is also an imbalance bit by premium, which is a type of inefficiency found in breakup blocks. Okay, so now you have the market shift delivery below this candle, trades up into premium, and then sells off into our target. Now if you were using your Fibonacci from this high all the way down to the low, it looks as if it never gets up into premium. It looks as if it just remains like that. Now watch this. While we are selling a premium of this smaller range, we're also selling a premium of this overall trading range. because we're still above this block line here. I'll make it a dashed line so it's easier to identify. We're still above this line here, so anything above we want to be selling short there. Once we get down here, we don't want to be selling short there relative to this range. Okay, so we had a chance to sell short at premium. We have another chance to sell short at premium using advanced Fibonacci, advanced premium versus discount. This is what I call a change in delivery state. Okay, so I'm going to wrap this video here. You want to practice using the concepts I just taught on this video, and I will catch you guys all on the next video. We're going to start off with BPR, where I did an old presentation of that, and then we'll go more into fair valuation. With that being said, be safe, and I'll catch you guys all the next lesson.